Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we're going to talk about home price predictions for the basically a year, 2025 into 2026. We have a bunch of data on Zillow. We're going to cover Zillow's because they have the most information. They have a very rich article with a map and a bunch of stuff like that. We thought it'd be cool to share with you. And then we're going to go through all the other estimates because there were a bunch of banks that came out. So this is what I'm going to do. I'm going to put up the chart first. We'll talk about this a little bit, and then we'll dig into the Zillow.
Okay. So if this is interesting to you, fantastic. Hang out with us. Like the video, subscribe, hit notification bell. If it's not, hang out with us anyway. Go.
Yeah, and still like the video. Okay, so I'll just throw this up on the screen. Now, what these represent are a bunch of different banks, a bunch of different investment firms, and then institutions like Fannie Mae, and then companies like Zillow, Redfin, who basically have data analytics because they all do stuff that this is all important. And this affects a lot of things other than just like you out there, should you buy a house or not buy a house or anything. They have to track all this. So let's first start with we'll go hit these real quick and then we'll talk about these. So there are three, and now some of these are January of 25 to January of 26, and some of these are like May. Mm-hmm. They're all a little different, but they're basically, these are the most recent estimates for the next 12-ish months.
6 to 12 months, yeah.
6 to 12 months. Okay. Now, Juana, so there's Zillow, Redfin, Moody's, all slightly low. Redfin was the biggest bear case, minus 1%. And then on the other side, you've got like Fannie Mae, 3.4 to 4.1. They actually gave a range. NAR, 3%. Mortgage Bankers, 1.3. CoreLogic, 2. Goldman Sachs, Wells Fargo, both 4.4. I think one of them copied. That's like the Rowan Atkinson mean. You've got housing, like Wells Fargo is doing the math, and Housing Wire is Goldman Sachs is looking over, copying them. And then Housing Wire was 3.5%. Are these estimates historically extremely accurate, or like how did they all get within 5% of each other?
Well, they had the little thing, and then they spun the arrow.
They spun the arrow.
And it's just where it landed.
It's just where it landed.
Yes.
So they're historically, though, on average, like how well, do they do well, or are they close, or?
Some are closer than others. Probably Fannie Mae tends to do better. Mm-hmm. I think they have a better data set. But and then Zillow actually does pretty good.
Okay, so that's what we're going to talk about. So we're going to jump in this article that came out. You can find it on Fast Company. You can also go to Zillow.com. They have the whole report, the map, and everything. Okay, housing market map. Zillow just released its updated home price forecast for 400 plus housing markets. There's 330 or so that most of the banks all cover at a minimum. These are everything from New York City to Harlingen, Texas, like a very large to a smaller area. Mm-hmm. And then Zillow covers more. They have it broken down into like 400 separate housing markets for the whole U.S. They have the most. Okay, and Zillow projects home prices will fall 0.7% from May 2025 to 2026. One, does this mean somebody watching the video, their house will be worth 0.7% less in May versus today?
No, but they could be 0.7% older.
They will be a lot more than 0.7. I predict they will be over 1% older for most people.
No, in all seriousness, no. Look, these are numbers that are national, and they put everybody together and then divide it back up. And so some people are going to be maybe up as much as 5%, and those might be down, 4 point something percent or whatever. So this is kind of what it looks like nationally.
Okay, so this week, newly released data for Zillow shows U.S. home prices have decelerated to a year-over-year increase of just 0.4%. So year-over-year from last year, it was kind of cooking a little bit, and it slowed down. Really, last few months have been kind of slow. This is probably the slowest spring we've had since 2019. Like certainly 2020, 21, 2, 3, and 4 were much hotter, like substantially hotter.
Right, but look, we've had a lot of anomalies over the last 5 years. We had hot, September, October, Novembers, which we don't normally have. So, and I don't just mean the temperature; I mean the amount of transactions that were happening and price increases. So there's been a lot of change, and so we've had a lot of things that are out of the ordinary, and we're still kind of settling out from the pandemic. I mean, I know that the pandemic is way back there in the rearview mirror, but we're still kind of recovering from that economically and in housing.
So up 0.4% for a year, down 0.7. Basically, it's a wash for the last 2 years for most people. Okay, with inventory up nearly 20% over the previous year, buyers had more options in May than any time since July 2020. So the inventory is the most it's been only since 2020. The total inventory is actually still less than it was in 2019. If it was more, they would have put a later year. So this is
earlier year, yes.
Yeah, an earlier year. Despite higher sales, sellers still outnumber buyers, wrote Zillow economists. That give buyers more time to decide, more power in negotiations. Juana, isn't that kind of the definition? I mean, this is more of a normal market than if you're only looking at if you were born in 2000, this is probably the worst real estate market you've ever seen in your life, right?
If you're born in 2000, you don't care.
I mean, 2020. Okay, but being born like a long time ago, like Gen Xers, like we are, this is kind of, we're back to normal, right?
Right.
Okay, so what we're going to do here is I'm going to pull up this chart. This is a national chart. You can go find it online. It's super easy. Now, what's interesting is the chart shows all the way on the left -8. Now, this is for the next year, what's projected. All the way on the left, it shows a -8. All the way on the right, it shows a +8. What's interesting is nowhere is the worst performing market -8. We're going to show you the markets, the top like 5 or 10 that they predict for price increases, the top 5 or 10. And then they show this red and the blue, but if you look at the chart, there's really none of that. The biggest one there was a New Orleans -7.02. That was the biggest down, but there was no -8. And there was nothing that was +8. There's, like I said, but when you look at this chart, it doesn't look like it's mostly yellow. And if you up there, it says yellow is basically 0% or somewhere between 0 and down 1%.
Okay.
It really looks like there's very little going on except for Louisiana, some parts of Texas. We're going to hit these markets individually, by the way. Over there in Vegas, we got the yellow, which is basically the 0. If you look at most of the U.S., San Jose is a little darker, -3.8. But what are you seeing when you look at this chart and see it's basically, I mean, if you took out Louisiana and parts of Texas, the whole country looks like we're just kind of hanging out.
It's just stable. I mean, there's no major up or down, unless, of course, you're the one trying to buy a house and you're facing multiple offers. They're still out there, but they're few and far between at this point. Remember, this is just a generalization, and it doesn't necessarily reflect what you're experiencing.
Okay, I'm going to just hit this one really quick before we hit the ups and downs. Las Vegas, which is our metro area, they're projecting 0.4% Juana. If somebody finds the perfect house, should they wait next year and get it at 0.4% less, or should they just buy it now?
Well, it's like with all things perfect, get it while you can.
Okay, here we go. We're going to start with the downs. Do the bad one first. Okay, among the 300 largest housing markets, Zillow expects the weakest home price appreciation between May to May in Louisiana, -9.4, Houma, Louisiana, I don't even know where that is, Lake Charles, -9, basically, New Orleans, -7.2, Alexandria, like the top 5 worst markets are 6 are all Louisiana. And then you got Texas, San Francisco, and 2 more in Texas.
Okay, so if you're in Louisiana, tell us what's happening down there and the reason for this, because this just seems a little bit out of place. So is there something happening economically in Louisiana that's causing people to move out of the area, and that's why this is happening? Tell us what's happening in Louisiana.
What's interesting about this chart is there's nothing Florida on here, and the Crash Bros are just all over in Austin, Texas, are just all over Florida. Like they keep, because Florida's had ridiculous inventory, like no inventory the last 5 years. And all of a sudden they'll go, oh, there's 80% more inventory than there was the bottom of the market when there were 5 houses on the market. And now there's 11 houses on the market or whatever.
Right. Florida has more inventory for a lot of reasons. And, we are aware that Florida is struggling with insurance. We are aware of the things going on as far as with their high rises and the legislative things going on. When you're looking at the big picture, the Zillow does not reflect a massive price crash in Florida.
What's interesting is Florida is so yes, there's a big inventory, but they also have the highest number of people moving there ever. They're projected, I think it's 2026. It's before the next presidential election when they redo the electoral college before the 2028 one. That between Texas and Florida, they could gain as many as 7 electoral votes between the two states.
Wow.
California is going to lose like 3 or 4. Illinois is going to lose them. Like a bunch of Northeast states are going to lose 1 each. And the real winners are going to be like Texas and Florida. So Florida has a ton of people moving there. So yeah, they have higher inventory, but it's also being absorbed. And so you'll probably see sales in Florida at a higher rate too, because remember, as you get more inventory on it, does that incentivize more people to go look in the housing market? You get some softness in price, you have more ability to negotiate, right?
Well, you just have more choice, right? Because something I've said for a long time, part of the reason for the diminished number of transactions is lack of product that people want to buy. Not lack of product, but lack of product people want to buy. So with an increase in inventory in Florida, it makes it more likely that there's product out there that people want to buy.
Okay, here is the 300 of the 300 markets, the ones with the most. These are the top 10 most appreciation. Atlantic City, New Jersey, up 3.4. Kingston, New York. Knoxville, Tennessee, 2.6 even. Pottsville, Pennsylvania. It's not very big, but Torrington, Connecticut, and then Rochester, Syracuse. These are all in the Northeast. Okay. And then Arkansas, Illinois, and Arizona. Yuma, Arizona, that's funny. And the Marine Corps, they have a base there. And we used to, they had a live weapons range outside. And we used to go drop live bombs out. So we'd fly out of Yuma and go to the mountain range out there and drop live bombs. But I mean, this is pretty benign, right? Your top 10 markets, you're just pretty, like only market that's really within the range of being a normal market is Atlantic City. Everything else is kind of, it shows it less. What do you think is going on in the Northeast? Do you think it's just all the people that left, maybe some are coming back, or what do you think is going on?
Well, yeah, I mean, I do think that people are coming back to the Northeast. The Sun Belt is not for everyone. Everyone thought that was a good idea. Like I said, during the pandemic, there was a lot of shifting around. But at the end of the day, people want to go home, whatever that means to them. So people who came from the Northeast, some of them have decided that they want to go back to the Northeast because that's where home is.
I'm going to put the chart up here with the national numbers again. What is it, do you think, that, Goldman Sachs, mortgage bankers, and Fannie Mae, who are all predicting up 1% to 4%? And I don't know that I agree with that. I mean, as far as I'm concerned, I think the Zillow estimate is probably the best, right? Down 0.7, really super flat year. We got a lot of criticism 2022 when we said home prices would moderate. In a way, we were wrong because home prices are higher, much higher today than they were in 2022. They had a dip in the fall. Remember, every spring to fall, home prices fall. It happens every year.
Well, almost every year.
Almost every year. Anomaly year it goes up, but it drops every year, and then it rises again. So that's what you're going to see. You're going to see, if they were only estimating to the fall, you would see these numbers pretty much all negative or zero, and then from the fall it would come back up. What do you think? Are they not watching Reventure and the other crash bros? Because they're predicting like 50 to 70% crash in some markets. And clearly none of them are saying, like, they have data that, like, these professional companies that do this for a living that probably have dozens, if not hundreds of analysts analyzing all this data.
Right. So I think maybe they're looking at different things. The crash bros have one agenda. And then as far as, the Fannie Mae's, the Goldman Sachs, the Wells Fargo's of the world, their agenda is to protect their money, which means that when they initiate a loan to a borrower for real estate, they want to know that property is going to not diminish in value substantially against the money that's being loaned, because that affects their bottom line, right?
Right.
They do have to keep track of that on their books, money loaned out versus the collateral. So I think that there's a substantial incentive for them to get it right, because they need to make sure that they are sufficiently collateralized against the loans that they're issuing.
And they make a lot of economic decisions. So these companies, somebody like Goldman Sachs, they're giving advice to clients with literally manage hundreds of billions, if not trillions of dollars for clients.
Sure.
And they've got to know everything going on in the economy to advise all of their clients about everything.
Well, yeah, and remember, they're investing in REITs, they're investing in all kinds of things, so they're not just issuing mortgages, they're investing in real estate in all kinds of different ways.
There was a few years ago, the financial managers, people who manage people's financial assets, were struggling because the market was kind of down and people were pulling stuff out of the market because they were worried about the things happening with COVID and other things that were happening in the economy, and they were going to cash. So what happens is we converted 7 or 8 trillion out of markets into cash, and that went into money. A lot of it went into like money markets, or just went into household cash and things like that, right? And then so the financial people all got together basically, and we heard the same story from all of them. You need to sell. This was like 2021. You need to sell all your real estate and just get rid of it before it's going to crash, right? They were like in 2021, you can sell it and get rid of it, and then put it all where I can manage it. Because like right now, I manage $2 million of your assets. But if you sell your $500,000 house, you can put that 500 in with the 2 million, and I can manage 2.5 million of your stuff. Why would they recommend that?
Well, because a lot of them get paid based on the amount of money that they manage, whether they get paid on the front end or the back end, right? So whether it's a management fee that they charge on the front end, or whether they get paid based on on the investments that they make on your behalf.
I would not want to be the firm that got a bunch of people to get rid of their 2% mortgages in 2021 to go put it in the stock market and have someone manage it and find out that now they can't go buy a house because the home prices are much higher and interest rates are much higher.
Well, so is the stock market, so maybe people have money to go buy another house.
I mean, if they put it all in Tesla and NVIDIA, they probably did.
There you go.
But anyway, so bottom line is this is, and before you get, and a lot of people get critical, these are not our numbers. We didn't make the numbers up. They all came from articles. You can just look them up yourself if you want. You can go find out where the data came from. We're just talking about why we think. I actually think, personal opinion, this is a bit robust. It said Vegas was like minus 0.4%. I think Vegas could be flat for the next year. I think a great buying opportunity maybe in the fall. I think if we get good inventory, we have to have. We're still below 2019 inventory, so we need to get maybe double the amount we have now into the fall, and I think there'll be some deals in Vegas for buying. Right,
but I mean, when we say deals, we're not talking that you're going to get 10% off. Okay, I mean that's not what we're saying.
Right.
If you have to kind of take it in context. So if you're looking to buy a $500,000 house, could you maybe get that house for $485 in the fall? Okay. But is that a massive discount? Well, no, it's not. It's a pretty nominal discount versus just getting the house that you want. You're not going to go buy a house for $485 because it's $485 versus spending $500 on the house that you really want and it's in the right location. It's all about finding the right house for you that suits your family's needs, all of your other needs, and it makes sense for you at a time when it makes sense for you. So keep that in mind. So if you're selling, great. Sell when it's the right time for you to sell. If you're buying, great. Buy when it's the right time for you to buy and it's the right home for you. Timing the markets, it just doesn't work.
Okay, last thing. We, from the early 80s until just 5 years ago, we were in a rate cutting cycle, meaning for the most part, there were a couple times the Fed raised rates, but rates have slowly gone down from 18% to, the federal funds rate went to like 0.25 or some. That's when you got the 2% loans on the house. And then we went to this massive raising cycle where the federal funds rate went up to like 5%. But we've actually had 2 cuts. So I know that on the last, that Powell, the last time the FOMC met, he declined to lower rates. But now they're saying inflation's down, and Atlanta Fed is saying, we're seeing like 3.6% GDP annual growth and stuff. And so I believe this puts us in a cutting cycle that maybe lasts 3 or 4 years, where slowly over 3 or 4 years we see rate cuts that end up affecting real estate and end up having mortgage rates go down over the next 4 years. Do you agree with that? And if so, let's say that where you could basically get a 30-year fix at 6.5. Let's say next year you can get it at 6, and then 5 after that, 5.5, and then 5. And of course, if you got a VA, you'd get 4.5, right? Or if you got a 15-year fix, you can maybe get 4.25%. Where do you see that doing to real estate if nothing else changes? The same number of homes are being built, market's pretty stable, but we see rates go back down. Does that sort of push up home prices in 4 years?
Sure. I mean, short answer is yes. I think home prices over the long term are going to go up regardless of what interest rates do.
Okay.
Having lower interest rates, it's nice, it's helpful, but it's not necessary.
Home prices today are higher than they were at the beginning of 2022. Mm-hmm. That was 3 years ago when interest rates were literally below 3%, like mortgage rates were below 3%.
Right.
And then the conventional wisdom is, well, how can they? That's not physically possible. Crash Bros got this wrong because they don't understand basic economics. Right.
So we have more people, we have more demand, and we can't build fast enough to meet that demand. So yeah, prices for homes are going to go up like they always have. And what I mean by that, I don't mean that they're going to go up 20%. I mean that they're going to go up consistently, slowly over time. Some years they'll make more progress than others, but over time, real estate will appreciate.
Barring black swan event, like great financial crisis or something.
Right.
Yeah.
All right.
Right.
Hope you had fun. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us your real estate related comments, and we'll see you on the next video. Bye.
Bye.